Hello everyone and welcome to your show, Your Money, Your Taxes. I'm Lalit Abichandani, CPA and owner of Abic CPA Associates in New York City. And with me today here is Paresh Shah. He's a certified financial planner and he's also a CEO of Paresh Shah Financial Services. He has a CFP and a wealth strategist for past 17 years, helping individuals and businesses co-create innovative financial strategies. He's licensed CPA presenter. That means that he's educating CPAs as they guide their clients and investments and life and disability and long-term insurances. He specializes in pension and profit sharing plans and asset protection, estate planning and business succession planning. Paresh ji graduated as a chemical engineer from the prestigious IIT at Kharagpur, India. His strong sense of professionalism and community service has kept him active in India as well as in the United States. He supports healthcare initiatives for financially challenged. Paresh ji resides in Long Island with his wife Shimul and son Shamik. Paresh ji, last time you explained how the amount of life insurance a person should own was decided. Although you made it sound simple, can you again briefly go over that again, please?
Sure, Lalitji. First of all, thank you for the great introduction. Really appreciate that. Now, insurance is meant to replace an economic loss. So all along what we've been talking about human life value. And we've been talking about that a pool of money must come to the family when a person dies, so that that pool of money can give an income to the family that replaces what that person was bringing home. And that's the amount of life insurance. So let us say that a person is 35 years old, he's making $100,000, and then let's say we have $2 million of life insurance. At 5%, that $2 million will give $100,000 of income per year, which is effectively replacing the income that he is bringing to the family. Now, not only is that the amount that is recommended, but that is also the maximum the insurance company will give. So effectively, we want to create a pool of money, have that for the family, and that the income from that pool of money replaces the income that this particular person was bringing home as he worked. And that's the way we want the life insurance to function.
So Paresh ji, once we determine what the life insurance amount should be, but then there are so many different life insurances types. There is term, there is index, universal life, whole life. Even I get confused with these terminologies. Can you please tell us what should a person select?
Lalitji, when I'm looking at the average consumer and life insurance, I'm thinking of myself walking into a store like Best Buy, and then there are these, these rows and rows of beautiful televisions, so like there is televisions from Samsung and Sony and all these different companies, and then each of them come in different sizes and with different features, and it gets so confusing as to what is the right thing for you to buy. And normally I think what you do when you go into a store and get into that kind of situation is you look around yourself for a few minutes, and then you try to find the guy who works for the store. And you kind of tell him what your situation is, and he in turn guides you. So that's, I think normally the course of action for a lot of people is they try to understand it themselves, but then they try to find a professional who will guide them in buying the life insurance. And as you said, there is so many different types. Like I'll give you one case that we did. We had a person who was making about $150,000 a year. He was 32 years old. So we recommended, and he purchased $3 million of life insurance. So what we did was we broke it up into different types. So we took 1 million as 20-year level term. Now this 20-year level term life insurance, what it would do is it would protect the family when this person passed away, but especially for the children. So till the children who were at that time, I think 5 years and 3 years, till they became 25 and 23, that means well past their undergrad education, this money would take care of it. Then the second thing, we also wanted the spouse to have support, and we assumed that this person would work till the age of 70. So we bought some term life that extended till the age of 70. And finally, we wanted some life insurance which had features like long-term care insurance with it, and also which could be used for some estate planning. That type of life insurance, we bought some whole life insurance that would last till the age of 121. So yes, there are different types of products, and yes, each of these products has a function, and you can either work on your own or you can employ a professional, a life insurance agent like myself, to help you to identify exactly what type and what you should try to get, you know.
But could you please explain some of these types of insurances? I mean, it's a maze of, you know, different policies. So can you just broadly categorize them for us?
Sure. Sure, Lalit. I would first categorize them into two broad categories, you know. And first category is what I call temporary insurances. So temporary insurances are what we typically call term life insurances. A term life insurance would be, say you would buy it for a term of say 10 years or 15 years or 20 years or up to the age of 70. That means it at a certain point, that insurance stops. You keep paying premium. Until you keep paying premium, you get protection, but at that point it stops completely. Now term life policy, as you can see, it's temporary. That means it ends. It does not last till you live. So it may result in money coming to the family, or it may not result in that happening. Just to give you a statistic, less than 1% of term life insurances result in the money being paid to the family when that person passes away. So if we look at that perspective, then the cost of a term life policy per $1 million of face amount or per $100,000 of face amount, that cost is very low. But it has a very, very good use. That means, let's say we have a young person and he is say 25 or 28 years old and making $100,000. I'm just taking that number. That means 30 times that. If you remember from the last show, Lalitji, we were discussing the multiple. So his human life value is about $3 million, and that should be the insurance. Now a young person at that age, just about to start his life, build his life, he can't afford to get paid large premium. So a 30-year term or a 20-year term life policy would be the great product for him to have. And then we can add one more feature on top of it, which is what is called the conversion feature. So in future, as his income goes up, if he says, okay, I want to now use my life insurance for say a longer period of time, I want to use it for some estate planning, then he can convert that term to a whole life feature without taking any additional medical. So that is a little about the temporary type of insurance which we typically call term life policies, you know.
But before we go on to the permanent policies, can you tell us the major uses of these term life?
Lalitji, first of all, for young families to be able to protect themselves at a low out-of-pocket cost, that is the first use of it. But we also see that term life has got a very extensive use in businesses. One example of it is, let us say for example you go to a bank and you're getting a loan. The bank will say that, well, you as the business owner are the main person running the business. We are loaning the money to you, but in case you pass away, the business will stop functioning and the business will not be able to repay our loan. So the business, the bank may ask you to buy some life insurance to protect them in case you pass away, and they can get their outstanding loan amount from that money. So there are certain banking organizations or certain loans which, if businesses try to avail of those loans, then they have to take the life insurance. So that's one example of use of a term life in business. Now, if you take the same example, you might ask me, why don't we use a permanent policy? Well, you want the protection till the loan is there. That means till there's let's say you have a loan which is going to be paid off in 15 years. That's the time for which the business wants the protection or the bank wants the protection. And so therefore you take a term policy which stretches for that period of time. Another use that I have seen in businesses is when you have a key person, let us say it's an IT company, and they've taken up a project which is going to last them say 5 years or 10 years, whatever that period is, and they have one key person who's their key programmer, and the project success depends on him being there. I mean, of course you can get another programmer, but that guy knows everything, and if he is there, then the project will get over in a shorter period of time and in a definite period of time. So you need him. Now, if he goes away and project overruns time, you're going to undergo loss. So you want protection against that, and that is taken by life insurance. That is typically known as key man life insurance. Again, since it is limited to the life of that employee is working with you, then therefore you want term. You don't want to spend money on getting a permanent or more expensive or more out-of-pocket flow life insurance, and therefore the term becomes very, very useful in that particular situation.
Great, Paresh. I think that's the easiest explanation of term policies. Would you now give us some explanation in the permanent policies, what use it provides and what really is a permanent life insurance?
Lalitji, permanent policies, very simply, are policies that will remain in effect as a life insurance policy before you pass away. That means beyond you passing away. That means most of these policies are there till the age of 121. So you pass away from your age, say you're 35 or 40, and going up to all the way till age 121. As you can see from the very definition of permanent policies, if they're going to go on till the age of 121, then the policy is going to outlive you, and most policies, permanent policies, will result in a claim. That means the family will get money, and therefore that's why it is called a permanent policy. But then there are various different types of policies, permanent policies, because they serve different functions. So to name a few, we have guaranteed universal life, we have then we have whole life, we have variable life, we have indexed universal life. These are all different types. What are these policies? What are the differences? What is the prime difference between these policies? The main difference is the way in which the amount in which the premium is paid, so that these policies can have different components that can be put to different use. And I'll give you an example of guaranteed universal life. Now, that is a policy that goes on till the age of 121. The amount of money that the family gets in case a person passes away is flat. It remains the same all the way from the beginning till age 121. Now, because it remains till the age of 121, it is a permanent policy. But at the same time, there is no cash value, there is no money. That means if you stop paying the premiums and you want to cancel the policy, then that policy, you do not get any money back. So effectively, this guaranteed universal life is a policy that's a permanent policy, no cash value. A whole life policy will have cash value. Therefore, you have to look at different features, Lalitji, and then decide what type of permanent policy you have.
Pareshji, this is so very clear now, but I still have some more questions in this whole life and term policy. We have very limited time today, so I would request you to come back again and give us more feedback on an explanation of this whole life and term policies, because I think it is very important that viewers can understand and effectively take the right product so that it benefits them, whether it is term policy or whether it is a whole life policy or it's a permanent policy. In some cases, we use it for estate planning purposes as well. So I would like to go a little more deeper into that in the next episode. For now, thank you very much.
Thank you, Lalitji, and we
coming
definitely
here.
say that anyone who needs a second opinion on anything, we are always open to that. we'll be more than happy to give anyone an opinion, you know.
Viewers, you can reach Paresh ji on his email that is posted on the TV screen, or you can reach him at 718-475-5346. Thank you again for watching us, and we will see you in 2 weeks.
Thank you very much.